Today I'm going to talk about some things you want to hear me talk about and some things you don't want to hear me talk about, and I don't normally talk about, but I think are quite important based on what I'm looking at the past few days. So we're going to get into that in the second half of the video. And first we're going to start with the fundamentals, this being the first down week for the market in over four roughly. It's been a rough stretch for shorts the past several weeks. However, I'm seeing plenty of signs that things are going to reverse. And I want to start with the good, the things that are looking good. Procter & Gamble reported earnings today. Stock's up big. If you're just thinking about, oh, that stock beat earnings, maybe earnings are going to come in better than expected, that would be a very, very obtuse way of analyzing the market and earnings right now. Why? Because what kind of stock is Procter & Gamble? It's called a defensive stock, also known as a recession stock. So why did they beat earnings? They beat earnings because they were able to, drumroll please, increase prices. And they increased prices on our necessities, laundry detergent, toothpaste. These are the kinds of products Procter & Gamble makes. Their demand is relatively inelastic. So 3% earnings growth due to price increases. You can't read a whole lot into that. And I think that's why the market was down in the pre-market, was down for most of the day, and not really looking too much at the Procter & Gamble. Next week, we have a very big week of tech earnings. Not all of them. Apple, big kahuna, day after the Fed meeting. I wonder why they chose that day. Maybe to blame something else, I don't know. Anyways, next week is a big week, much bigger week than this week, but we're starting to see signs of crack. And Amazon is up a lot today. There's some positive notes on that, but it was just a few days ago where the CEO of Amazon was on CNBC talking about how businesses are spending less on cloud, that they're seeing slowdown here. Businesses are pulling back spending. I was honestly shocked by the lack of market reaction to that. The Amazon was actually up at the close of that day. I think it might have been Monday this week. I think that's a pretty big piece of information that we'll see come to fruition next week, particularly on Amazon and Microsoft's earnings calls. Cloud is a very big aspect of both of those businesses. Andy Jassy, Amazon CEO, is specifically talking about those stocks. That's the growth engine for Amazon, particularly. Also a very important component of Microsoft, Azure, however it is said. So, pretty important stuff there. Now I want to start getting into the stuff you don't want me to talk about. And these are technicals. If you look at the technicals occurring, there are plenty of very interesting things. And I don't normally look at technicals. That's why I don't talk about them much. That's why I said you don't want to hear me talk about it. But right now I am looking at technicals because there's some very interesting signs, and you need to look no less than the Apple chart today. Apple is the stock market, typically. It's the biggest company. It's very important. People view it as a safe haven. But its chart, its trading today was very, very, very weird. Very weird. Just basically going like this across 165. And the market was like this all over the place and had very visible patterns, and many stocks followed those very visible patterns. Apple did not. It did not. It did its own thing, and that's an unusual thing. So I don't know what the answer is here, but I view that as a 165 might turn into what was a floor, might turn into a ceiling, and maybe we'll break below that. If you saw Tesla, once it broke below 170, that was a big deal. So I think these levels, these psychological levels, are going to be pretty important for a reversal. If we can break below these levels and on fundamental basis go through, it might lead to some continuation of that and a mindset shift away from, oh, these stocks can only go up, to, oh, these are expensive, I have to realize some gains. And a lot of people own these stocks. These are the most thoroughly owned stocks. People have gains on them. We're going into a slowdown, possibly a recession. it makes sense to realize gains. And that might snowball on itself. That's my expectation. So we'll see what happens over the next coming days and weeks, because this is the most crucial period of the year so far, in my opinion. Technicals, interesting, but it's not just Apple. You look at the broader markets, ever since Netflix and Tesla reported, this is the start of real earnings that matter to us, tech earnings, the stuff that has done so well this year. We're cracking the earnings picture in pretty much anything that's exposed to tech. NASDAQ earnings are down 27% year on year. That's not an unimportant amount. That is a meaningful amount. Valuations need to adjust for that. Some of them are, some of them are not. They're definitely not growing. It's more than just 20%, 27%. They're not growing. That was the expectation, that they're going to grow or that they're going to remain relatively strong. At least maybe not the expectation. I get it. Q1 and Q2 earnings expected to be lower. They're expected to grow in Q3 and Q4. But the current prices reflect growth, and it's not coming to fruition. I think it's no surprise that the market feels a little stretched here. And I think we're seeing signs that the shell is beginning to crack. That's my genuine feeling. We'll see what happens over the next couple days and weeks. The last thing I want to talk about that I know you definitely don't want to hear about is crypto. Why do I want to talk about crypto? Because while I don't think crypto is necessarily tied to the market or has any bearing on what the market does or is in any way at all related to the equity market, it is a common form of speculation and asset trading, relatively high volumes, respectable asset sizes, or market caps. And it is puking right now. It is puking since Netflix and Tesla earnings. What does this mean to me? This means people are looking at those assets saying, I'm a little concerned about the future. Maybe it's time to lock in some of these gains. Let's not forget, Bitcoin was just at a local high, very meaningful local high for over 6 months or so, maybe even more than that. People are locking in the gains. They're selling their Bitcoin, and it is moving fast. If you look at what happened in January, stock market obviously bottomed and rallied, or local bottomed and rallied. Crypto rallied very aggressively at the start of that. So I'm not saying it's a fact, but I'm saying there's some correlation and there's some logical sense behind it, that when you see aggressive crypto selling, and the market starting to show signs of weakness, the fundamentals beginning to show meaningful signs of weakness, you might be at the beginning stages of a drawdown of some kind. So that is my read. That is my assumption. We'll see what comes to fruition. People are looking for areas to sell stocks. And let's not forget, or sell assets. At least that's what Bitcoin is telling us. Crypto is telling us. A lot of the fever we've been able to see this year has been because of a similar, crypto mentality. These long-term assets that are going to generate returns down the line because yields are low or whatever. So we'll see what happens with that. I had one more thing I wanted to talk about, but I just lost my train of thought for a second. Let's see if it comes back real quick. Anyways, crypto turning down. Yields still very low. They really should be a lot higher. The 2-year right before the banking crisis was over 5%. I don't know if it needs to be at that level. At that time, we were thinking more like 5.5 to 5.75% on the peak rate. Now it's down to more like 5.0 to 5.25, probably, maybe one more, possibly, but 4.2 is just too low for the 10-year. It has to be at least, or the 2-year, has to be at least 4.5. Otherwise, you need to cut rates, assuming the Fed this year is accurately doing what they're doing, which is the case in my assumption. I would put a lot of stock in that. They would need to cut rates like at the beginning of next year down to 3% to make that 2-year equation work. And that's just not going to happen. If that were to happen, there would need to be a severe recession. And if you've been listening to the Fed, they're not saying there's a severe recession. They're saying there's a possibility of it. They're not putting that away. They're kind of going to embrace that if it occurs, if it's mild. What they're saying is economic conditions remain strong. So they've done all this tightening and they're not seeing anything. They're expecting unemployment to go up. Loretta Mester, 4.75. That is over a 1% jump from here. Won't be catastrophic, but the important thing is they're building in some weakness. They're building in some economic slowdown. They're building in some unemployment. So you need to max that out. You need to max all that expectations that they have for a weakening economy to get to where they predict rates are going to go. And you need to get even farther than that, which is not a good thing for stocks, by the way. You need to get even farther than that to get what the market is pricing. So what the market is pricing, in my opinion, makes no sense. It's either we get a hardcore recession. We either get, the only possible good outcome is inflation drops like a rock here. And that is not my expectation. That's what the market expects. That's what the market's expected for a long time. That's not what I've expected for a long time. And the truth of the matter is, inflation has remained relatively sticky. All signs point to it being relatively sticky. What matters is core inflation, not CPI. And that's a wrap on today's video. So until next time, have a good weekend. Peace out.